structures, hopefully soon to be yours as well. As Wayne and Dee Dee know, I am absolutely passionate about spreading the word when it comes to consumer housing and worker co-ops because there simply aren't enough accountants out there who know how to serve these types of businesses. And yet they add so much to our communities when they're supported and successful. So it's not just a win-win, it's like a three-way win because at the same time as we're helping those businesses and communities succeed, we can help our colleagues expand their scopes to be able to take on new business. So again, thank you so much for the invitation to be here. Here's a little bit more about me on this slide. I've specialized in small business accounting for 25 years, but my work with co-ops started about 14 years ago when I joined the Dill Pickle Food Co-op just as they were getting started, my neighborhood co-op. They said, well, you're a member and an accountant, so let's work together. And I explained that co-op accounting and bookkeeping and tax was like really its own thing, and they needed to find someone else in Chicago to help them. And they came back and says, hey, yeah, so it turns out there aren't any CPAs in Chicago that know how to work with co-ops. So I agreed to learn if they would be patient with me. And thankfully, in the meantime, we've trained a lot of folks in the intervening years, especially as consumer housing and worker co-ops have become more popular. And there's just a much wider base for supporting our local co-ops now, with the added benefit that some firms can do a great deal of the work remotely. So these are types of co-ops we're going to be covering today, identified by NSAC as ones that members might be less familiar with. We're going to focus on grocery, housing, and worker co-ops since they're the types you're most likely to come across. Now, why are we calling them hippie co-ops? Cute story. My first NSAC national conference happened the same year as my first co-op professional guild conference, which at the time was sponsored by NCBA, the National Cooperative Business Association. And I was really surprised at the lack of overlap in the attendees and the presenters and the vendors between the two conferences. And at dinner one evening with some NSAC board members, I asked about it and they said, well, it's because those folks are a bunch of hippies. And at first I couldn't stop laughing because I'm one of those hippies. And so then when I served on the plenary committee of the CPG conference the following year, I asked about involving NSAC as presenters and was told, oh, they wouldn't be interested. They're a bunch of big ag corporate folks who don't care about sustainable economies. Well, obviously, what I found out in the intervening years was that they were both wrong and maybe a little bit both right. And as long as we could all keep laughing and working together, the entire co-op accounting community and the clients we serve will be better off for it. And for the record, ever since then, my closest colleagues and I have always called our clients hippie co-ops. Okay, why again are we here today? Quite frankly, it's because I have too much work and I want to give some of it to you. Oh, here's our first poll. Fantastic. This is asking what kind of experience you have so far with these types of co-ops. So you're going to have about 60 seconds to answer this, and I'm going to keep talking in the meantime. I have too much work. I want to give some of it to you. There are a ton of co-ops out there that need our help and not enough accountants who know how to do the work or how to court those potential clients. So please remember that the space that cooperatives operate in is broader than one might expect. By introducing co-op accountants to unfamiliar cooperative structures and areas, they can leverage their existing expertise in areas that are common to all co-ops, and they can build on that knowledge. And it's important to dispel the myth. Oh, good. We've got our polls up. Let's see. We got about a quarter of us working with at least one of these types regularly. Welcome. Very happy. I hope you learned something new today. Just enough to be dangerous. Okay. Yeah, you guys are. I'm really glad you're here. Oh my gosh, we've got fully 2/3 of folks have never worked with any of these, but can't wait. Well, I can't wait either. Thank you so much for coming today. It's important to dispel the myth that there are two separate camps of cooperatives, right? Like us and them or something like that. There are countless types of co-ops and they all have plenty in common. We really want to break down this barrier and provide the education that accountants need to build businesses across the entire co-op industry. Our intent here is to recognize what we have in common and explain the differences in order to identify and create additional business opportunities for co-op accountants. So to that end, please keep in mind, this is not an intro to co-op accounting. We're presuming that you're all already co-op accountants This is for those folks who are already co-op accountants to leverage what they already know. NSAC has a great webinar series on co-op accounting, taxation, audit, and the history of co-ops. Some of my favorite colleagues from the Co-op Professionals Guild are going to be teaming up with NSAC as well. So if you're more of a beginner, please check out some of those resources. We're glad to have you here anyway. But some of this might be a little difficult if you don't have any co-op experience whatsoever. All right, so economic impact. Why is it valuable to learn about these sectors that are unfamiliar to you? I want to take a quick look at the economic impact of co-ops in general. There are 14 sectors, including food, health, retail, agriculture, finance, utilities. I mean, honestly, we're talking about a huge cross-section of what's out there in the business world. Regarding membership, 1 in 3 Americans are members in a co-op, which is kind of surprising and amazing. They help provide over 2 million jobs, 700 billion in annual sales, $3 trillion in assets. According to consumers, co-ops actually rate higher than for-profit businesses in a bunch of different areas, often by a wide margin, actually. Consumers feel that co-ops have the best interests of the consumer in mind. They run the business in a trustworthy manner. They're committed to and involved in their communities. They're committed to the highest quality of service. They offer fair and competitive prices. They can be counted on to meet customers' need, and they provide products and services of high value. For younger generations, let's keep in mind that worker co-ops are the fastest growing cooperative sector, and they represent a critical opportunity for small, locally owned businesses to convert to worker-owned, keeping jobs and money in the local economy. And to that end, let's review the power of keeping dollars local. Small changes in consumer spending habits can generate substantial local economic impact. For every $100 in customer spending at a national chain, the total local economic impact is only $13. The same amount spent with a local merchant yields $45. So it's more than 3 times the local economic impact. We can help keep those small businesses in the neighborhoods through co-op conversion. And co-ops allow entrepreneurs to generate economies of scale, increase efficiencies along the value chain, improve the quality and the value-added nature of the products, increase access to capital, and gain substantial bargaining power rather than just trying to do it on their own. So let's start with consumer co-ops. Consumer co-ops are organized by consumers, that makes sense, who want to achieve better prices, quality, or access to the goods or services they purchase. So we're going to talk about grocery and other retail, housing, and daycare. These are all different kinds of consumer co-ops. Other types that might already be more familiar to NSAC members are credit unions, electricity, water, and telephone service co-ops, et cetera. They're all just different examples of consumer co-ops. So let's discuss the characteristics that make these types of co-ops different than other types. For those who aren't familiar with patronage refunds, hopefully we're all professional co-op accountants here, and so we're really familiar with patronage refunds. But just in case there's anybody on here who doesn't know what they are, they're sometimes called patronage dividends. This is a payout to members that, unlike traditional dividends, is actually deductible to the co-op, and it's a huge part of why co-ops are an attractive and more sustainable alternative to C corporations. So I'm going to start with patronage. First off, and this tends to be pretty mind-blowing to those who haven't worked with consumer co-ops, but patronage refunds from consumer co-ops are often non-taxable income to the recipient of the refund. And so we're not just talking about the fact that they're deductible on the co-op level, they're non-taxable income to the recipient. The phrasing is amounts which are allocated on a patronage basis by a co-op association with respect to supplies, equipment, or services, and here's the key, the cost of which was not deductible by the patron under Section 162 or 212, or not includable in the computation of the gross income of such patron. True fact. Basic idea here. If I'm a member of a grocery co-op so that I can get easy access to locally grown organic food, for example, and I'm responsible for 5% of the co-op's revenue this year, and that co-op has a profit of, say, like $10,000. It's just an easy number. then that just means that I overpaid for my groceries and I should get $500 refunded to me. I won't go into retained patronage here, but that is one way to build capital. You can have patronage that you're not paying out. The basic idea is you would get $500 refunded to you, because the objective isn't to make a profit. The objective is to get easy access to locally grown organic food in this case. So these purchases are personal costs. They weren't deductible to me in the first place, unless you're like the unusual case of someone running their own business who's like buying ingredients at the store. That would be a situation where this didn't apply. But most of the time, we're just talking about buying your groceries, right? So the patronage refund shouldn't be taxable. You're just getting your own money back. And it actually goes a step further. A cooperative determined to be primarily engaged in the retail sale of goods or services that are generally for personal living or family use of the members may ask for and receive exemption from even filing Form 1099 PATR in the first place. So like grocery co-ops, most of them don't issue 1099 PATR. You just use Form 3491, which is the Consumer Cooperative Exemption Application. Super easy to fill out. Make that happen. On this slide, I've actually linked to a great primer on grocery patronage by Bruce Mayer of Wegner CPAs, who taught me so much of what I know. It's a great resource. Make sure to download the slides and click on that link. Another thing that tends to differentiate consumer co-ops is that some have an outreach component intended to address what are called collateral goals, like economic equity, racial disparity, and other community issues. How to structure that outreach component is a topic of much discussion among co-ops because there are quite a few options. You can partner with a nonprofit fiscal agent. You can create a separate 501c3 that gets funded by the co-op itself, or you can book it as marketing or non-operating expense. I mean, there are a lot of different ways that you can do this, but collateral goals is a pretty common thing that you see across these types of cooperatives. Grocery and other retail co-ops sell products to members at retail, and as I mentioned, are usually formed by those who recognize a need and help organize a co-op to see it filled. Unavailability of a full service grocery in a community is a common one. REI, which I'm sure most of you are familiar with, they were founded in 1938 to make it easier to acquire quality pickaxes for climbing. Seriously, that's like how they got their start. Seminary Co-op founded to make academic books less difficult to find. And in turn, they've actually come up with some solutions which are now common industry-wide, not just in co-ops either. Like food co-ops have been pioneers in unit pricing and nutritional labeling and the sale of bulk and natural foods. That was really started out with grocery co-ops. So some things that are common across these are that volunteers are really common. And that's really challenging because how do you conform with labor laws, right? It's not a nonprofit. So you do have to conform with labor laws. In order to have a volunteer working at your grocery co-op, they must either qualify as governance, meaning being on the board, that's allowed. It must be a position for which the company would not normally hire an employee. So outreach and those collateral goals that I talked about, that would be an example of something acceptable there, or an internship if there's an educational component. These types of co-ops are subject to many of the same problems characteristic of democratic government. And it makes them a challenge to work with as a CPA. There are too many cooks in the kitchen, not enough expertise. Not everybody agrees. It can be kind of difficult to work with sometimes because of that. Community buy-in is often important, given that the members are the purchasers of the retail items. So in fact, to get a loan, like a startup loan, they almost always require proof that the community is involved. And that could be from getting loans from individual members in a community and doing a membership drive early on. Members often do not cash their patronage checks, which makes me insane. It makes all of us insane. That causes invalidation of the co-op tax deduction. And so there are a lot of creative ways that you can handle that. For example, by giving it back at the register in the POS system as a discount, things like that. There's a link to some creative ideas over here. Now, in 2005, there was a USDA-funded report prepared by the University of Wisconsin Center for Cooperatives, which is an amazing resource. They're so incredible, in which they identified keys to success and reasons for failure of rural food co-ops. Now, these are pretty typical of any retail business, but they apply particularly in the case of food and retailer co-ops, which are often organized by volunteers. The keys to success are strong operational management, member community and industry support, reasonable competition, and dedicated organizers. The contributions to failure are high turnover of leadership and management, too many collateral goals, lack of rigorous financial analysis, a poor location, or a failure to change direction quickly. So these are some examples of some grocery, food, and retailer co-ops. I'm not going to go through the list of examples in each section, but I provided them so that when you download the slides, you have links to make further research easier and more fun. I'm going to take a brief pause here and ask Wayne if you've got any questions that have come through in chat yet.
Not at this time, but I'm sure we'll get some soon.
All right, great. I'll keep moving on then. All right, let's move on to housing co-ops. Now, this is a type of consumer co-op where people come together to own and control the buildings in which they live, they themselves. They establish a corporation and they pay a monthly amount to cover its expenses, the expenses of the corporation. So a very important point here, housing co-ops are not considered real property. I would say it again, housing co-ops are not considered real property. When you buy into a co-op, you become a shareholder in a corporation that owns the property. And as a shareholder, you're entitled to exclusive use of a housing unit in the property. So by contrast, condominiums are multi-unit dwellings with privately owned residences and shared common areas. And condominiums are classified as real property, meaning that the buyers actually own the deeds to their dwellings. That's a really important distinction. Housing co-ops often sound a lot like condominiums, and they're very much not. So what happens in a housing co-op is that the market value of each member's interest increases as the co-op's mortgage is paid down. Now, to purchase shares in a housing co-op, each buyer might take out a share loan, is what it's called, to pay the cost of buying into it. But this has nothing to do with the underlying mortgage on the property itself. A share borrower must individually qualify for his or her own share loan and is individually liable for that debt. So why housing co-ops? Co-ops can be less expensive than market rate apartments because they operate on an at-cost basis. Remember the grocery example that I gave of the profit essentially meaning that customers were just paying too much? In a housing co-op, it's similar to that. They simply are collecting money from residents to pay the bills of the housing co-op. 85% of the housing co-ops are in New York City, where the cost of living is really high. So that tracks. It's a way to get out of the rental market at what can be the same monthly cost, but with the tax advantage of itemized deductions and with equity building. The spreading of costs among members helps cushion the shock of emergency repairs that in the single family homeowner space often leads to mortgage delinquency. And also compared to condo ownership, there are fewer closing costs, lower closing costs. Because homeowners may have a greater stake in their communities, what you see a lot is economic development organizations and local governments, they often support housing co-op development. There are many different types of housing co-ops. I'm not going to go into all of them here because honestly, sky's the limit in ways that lawyers can dream up how these can be created. There's a lot of flexibility in how they're set up. The University of Wisconsin Center for Cooperatives, which I will keep mentioning because they really are the best. They have a great guide to housing cooperatives that I strongly recommend if you're interested in learning about the specifics. So again, make sure to download the slides for that link. Again, examples, I'm not going to go through the list in each section. Oh, good. It's time for our second poll. Does a housing co-op member get to take the Schedule A deductions for mortgage interest and real estate taxes? This is a great question. So the answers are yes, if they otherwise qualify to itemize limited by the SALT cap. No, since the housing co-op takes the deduction on the 1120C, individual members are not eligible. I only do the corporate tax return, so it doesn't matter. I don't care, which is a viable answer. So I'll give you about 60 seconds to answer that one while I go back to this example slide here. I'm not going to list all of the examples, but I really encourage you to look into some of these. They are so creative and they have a ton of history. Many of them date back to the 50s and 60s, and they really run the gamut in terms of the communities they serve. In particular, check out a neat film called The City for a really interesting look at Greenbelt. Greenbelt's like one of the most interesting ones out there, in my opinion. Crazy, crazy history.
Nancy, we do have some questions, maybe after we
Great.
go with the results here.
All right, fantastic. Yes, if they otherwise qualify to itemize limited by the SALTs. Yes, that is the answer. That is the answer. And that's 39% of folks got that right. No, since the housing co-op takes the deduction, that's a confusing one because the co-op does take the deduction. So we actually have legal double dipping going on here. It's amazing. It's such a good deal. So what's happening here is the housing co-op is taking those deductions on the corporate return. But what normally happens is you'll have like a little spreadsheet that says, well, here's the percentage ownership of each of these people. Here's what the deduction that was taken for interest and for real estate taxes. And you just send an email once a year to everybody saying, here's what you're allowed to take on your taxes as a deduction on Schedule A if you're otherwise eligible. So it's pretty awesome. So what questions do we get?
Okay, we have 3 so far. The first one is, can you provide a reference regarding collateral goals?
That is a great question. Not off the top of my head, but if you remind me afterward, Wayne, I would be happy to get in touch with whoever asked that and look something up for them. I'm going to actually reference the University of Wisconsin Center for Cooperatives because they generally have a reference for everything. But the concept with collateral goals is just that most of the time when you're creating a co-op of one of these types, you're really trying to make a difference in your community. And so one of my favorite phrases is no margin, no mission. If the co-op's not making enough money, they can't then exercise their collateral goals. They have to make sufficient money to be able to fund those collateral goals, or they really need to set those goals aside. One of them that is really, really common is providing a living wage. That's something you see at a lot of grocery co-ops. They tend to have higher wages and better benefits than a regular grocery store because that is a commitment to a collateral goal. That's a good example of one, but there are lots of them out there.
Okay, next question. Thank you for that. Next question is, are share loans considered, quote, secured by the share?
That's another great question. I'll have to ask. My go-to is Brian Dahlk from Wegner CPAs. He's the housing co-op expert, and NSAC was saying they might have him come and do a deep dive on housing co-ops at some point, which would be great. I'll have to ask him that because I've never had that come up. I don't know.
Okay, great. The next question, if a housing co-op is not real estate, how does one build equity?
Okay, so that makes sense. So think of it as an investment in like a stock or something like that. As the company that you bought stock in, as their assets increase and their liabilities decrease, the value of your stock goes up, right? That's what's going on here. The assets of the cooperative, they own this building. That mortgage is getting paid down year over year over year. So the liabilities are going down. So the market value of your share is actually going up as a result.
Okay. The last question we have, okay. Are Are you familiar with any housing co-ops that are organized as an LLC electing to be treated as a cooperative corporation for tax purposes?
No, but that's not a problem at all. I don't see why. I mean, any LLC that is a multi-member LLC can elect co-op tax treatment the same as if you were electing C Corp treatment or S Corp treatment or whatever. So that actually makes some sense to me, because in the real estate world, you tend to see buildings will be individual LLC. Each building will be an LLC. If somebody owns a bunch of properties. And so it wouldn't be surprising to me at all that somebody might want to convert to a co-op at some point rather than dissolving the LLC and then having the co-op buy it. Yeah, I could see that. That would make
Okay.
sense.
I have one other question, then I'll let you move on. How does the land of housing co-op being owned by a nonprofit versus a C corporation impact accounting?
Oof, that would be another question for Brian. I've never had one that was set up that way. But it is pretty common, as we'll see on this next section on daycares. This might answer a little bit of your question. It is not uncommon for somebody to not elect subchapter T, which is the co-op taxation, and instead have it be a nonprofit, or subchapter K. Those are actually really common in all different types of co-ops. And so that makes sense. I think that it would not necessarily be the best approach in a housing co-op, but that would be a bigger topic that I think would be more of a deep dive that Brian might want to do and talk about the pros and cons of that and how it would be different.
Okay, we got one more question that fits this
Wow, people
territory.
are really excited about housing co-ops. This is great.
Yeah. So, and it's relevant here, so I'm going to pose this. Many housing co-ops have a limit to cost of selling or buying a unit. How does that impact increasing equity?
Yeah, that actually does generally keep. It's interesting because if you think of it this way, your market value in a sense is lower because you got these limits. So anybody who wanted to buy the building, the market value would be lower because it's got this baggage associated with it, right? But if you're living in that co-op, that actually increases big time the market rate of your investment in that co-op, because the amount that you're going to pay on assessments or whatever is lower. So there are two different ways of looking at this. I mean, I think the important thing to realize about all of these different types of cooperatives that we're talking about is that the goal is not to make a profit. The goal is whatever you formed that co-op for. And you have to have enough money in order to reach that goal and your collateral goals if you have those as well. But you're not trying to increase your equity. You're trying to have a really great place to live. And so the market value of these sometimes can get to be pretty high, but you're not going to be selling the building to somebody else. That's not your goal. You're not trying to make this really, really valuable and then, sell it to a big corporation that's just going to drive up everybody's rents or whatever. Does that make sense?
Okay. Well, that's the last
really
of
have
our
to
questions
put
for
on
now.
a different set of glasses when you're thinking about these types of co-ops.
That makes sense. Well, thank you.
Sure. All right, moving on. Let's talk about daycare co-ops. I just want to touch briefly on them. They tend to be made up of parents of kids who attend the co-ops, and they depend on parent assistance in the classroom. So they're usually organized as 501c3s. We were just talking about that in one of those questions, right? This is a great example of a type of co-op that generally organizes 501c3 because of those labor issues that I mentioned earlier, right? If you're depending on parent assistance in the classroom, especially if it's volunteer or under market, then you're going to have a problem with that. Whereas 501c3s allow the volunteer labor, as well as the tax benefit. I mean, if you're educationally oriented, then you qualify to be a 501c3 and you get a tax benefit from that. But the key here is that they are operated using the co-op model. And this goes back to the questions that people were asking, you know, whether you're under subchapter T or K or you're 501c3 or whatever, they're called co-ops because they're using the co-op model. Different states have different statutes about using the word cooperative. Some of them actually require you to be under subchapter T or under the state statute for cooperatives, and others open it up and they let everybody use that word. So the key is that you're operating using the co-op model, and we all know the main tenets of co-ops. Practice note, by the way, that I just want to mention here, if you work with any daycare co-ops, make sure to issue annual letters to parents that have the EIN and the amount paid for the year so that they can claim the dependent care credit. Neither co-ops nor nonprofits are exempt from that. And that's a common misconception. So I just wanted to toss that in there. You're actually working with these, that's something you got to make sure you do. So the basic difference between these models is who sets up the co-op. The parent model is the most common, which is composed of parents who have formed a co-op to provide care for their children. And as with all co-ops, members contribute an initial membership fee toward the capitalization of the center, and they elect a board of directors on a one-member, one-vote basis. The board sets long-range policy and oversees the center's professional management. That's how that one works. There's another one that's becoming more common called the employee model. Now, this is where employers are including childcare in benefit packages for their employees, and they're establishing childcare facilities on or near their work sites. So the business might provide space, initial financing, and various assistance to these programs, but they leave the operation and the ownership to their employees whose kids attend the center. So they're parents as well, but they're also employees of this organization. And this is really fun. The US Senate and the World Bank are both examples of this employee-owned approach to childcare. So that's kind of fun. And then there's the consortium model. So this is a model where multiple businesses are acting together to offer childcare services, for example, in industrial parks and commercial developments for the benefit of those employed there. So it's owned by the combined employee groups. Sponsoring organizations typically provide the startup capital for the venture, and they donate space for the center, and they hire management. And as always, the co-op is governed by a board of directors selected from the membership, but these, because there's more than one business that is setting this up, these will have representatives from participating employers that are on the board as well. There are some really cool approaches to providing daycare out there. So some examples of daycare co-ops. I just wanted to call your attention in these examples to the parent co-op, which is actually jointly owned by the families and the professional staff that work there. So it's part worker co-op, which we'll talk about next. So worker cooperatives. I would love to introduce the fastest growing sector of co-ops. The US Federation defines a worker co-op as owned and controlled by its workers who constitute the members of the cooperative. So that's a pretty simple definition. But the World Declaration on Workers' Cooperatives has an 8-page definition. I won't go through all of it. I will do my best to summarize because they make some very, very good points here. So worker co-ops have these objectives: to create and maintain sustainable jobs and generate wealth, improve the quality of life of the worker members, dignify human work, allow workers democratic self-management, and promote community and local development. Talk about collateral goals, right? Number 2 is a general rule: work shall be carried out by the members. This implies that the majority of the workers in a given worker co-op are members and vice versa. Number 3, the worker members' relation with their cooperative shall be considered as different from that of conventional wage-based labor and to that of autonomous individual work. And number 4, their internal regulation is formally defined by regimes that are democratically agreed upon and accepted by the worker members. So, as you can imagine, it's pretty hard to pull off something so idealistic, but when it works, it is such a beautiful thing to be a part of. The breadth and scope of worker co-ops is astounding. You'll see them in every sector of every industry: service, retail, healthcare, skilled trades, manufacturing and engineering, technology. We're actually seeing a ton of technology worker co-ops these days, education, media, and the arts. There's, I mean, just really everywhere you look, you'll find worker co-ops if you know what to look for. So some distinguishing characteristics is that worker co-ops were created in response to worker abuses due to a profit-first mentality. They tend to be focused on fair wages, insurance and healthcare benefits, and are really being embraced by millennials as an alternative to the corporate structure, with ownership as a key factor. So maybe you want to own your own business, but you don't want to go in on it just on your own. You team up with a bunch of other folks, you create a worker co-op. Profit is generally allocated on the basis of hours worked for the company or a similar allocation, not on how much you produce, sell, or use the services or products. Workers have representation on and vote for the board of directors, adhering to the co-op principle of one member, in this case worker, one vote. There are over 500 worker co-ops in the United States. It actually went up during the pandemic by a lot, and is a fast growing sector, especially in response to independent contractor classifications in certain industries, such as delivery services and healthcare services, where workers are, in my opinion, incorrectly classified as independent contractors, and they're really taken advantage of. And we're also seeing a lot of conversions from small business to cooperative structure owned by workers, especially as part of a succession plan. They have varied structures. Consumer and other co-ops are often multi-stakeholder co-ops organized simultaneously as worker co-ops, as I mentioned earlier in the daycare example. Organized as more than one entity with a worker as one of multiple parts. That's another way it can be done. Or not organized as co-ops at all, like we were talking about before. They can take on any number of legal forms, although they are operating using co-op principles. The Cleveland model is actually a term that is used to describe economic development collaboratives, such as the Democracy Collaborative in Cleveland, which is where it got its name. To help start worker co-ops, they'll partner with large hospitals or large universities and get contracts that provide the work to the co-ops, which are generally located in disadvantaged communities. So that is a really, really neat, like another way that worker co-ops can really benefit the communities. There is a great article here on this slide. Again, you have to download the slide to click the link, that I strongly encourage you to read, which I find very interesting. The creative ways to leverage co-ops to build community wealth. It's very inspiring. However, I will say it is not all ideals. There are some super frustrating challenges, especially from a CPA's perspective. Unresolved conflicts with labor law. These can be really, really difficult. Department of Labor and state rules for corporations regarding workers' compensation, unemployment, minimum wage, benefits, and so on, which cause many worker cooperatives to use non-cooperative legal structures like partnerships under subchapter K, like I was mentioning earlier, while maintaining a commitment to cooperative principles. They're often organized as multi-member LLCs taxed under subchapter K, and let me tell you, it is no fun at all to prepare a partnership tax return with over 100 members when easily 20% of them each year are coming or going. It's awful. But the idea here is that independent contractors have no benefits or protections at all. They're better off forming or joining a worker co-op, but that doesn't mean they can afford all of the worker protections required by statute. But the second that they can, I always make the case for a conversion to subchapter T, because man, they are a pain in the rear, I will tell you. Also, even when taxed as a co-op under T, there are still potential employment tax issues. And this happens if all the members' income in patronage is reported on 1099 PATR. In other words, if you're not splitting it between the W-2 and the 1099 PATR, if you're paying out all the members' income as patronage and members don't then report it as self-employment income, that's a serious potential employment tax issue right there. So I generally recommend instead that worker income is split between W-2 for services provided and what we would normally think of as profit distribution. That would be patronage, right? That's the part that they're sort of getting back of their own money. That portion of it, that is the part that goes under 1099 PATR. It's kind of like the two hats that you wear when you're working with an S corp. The key, either way, however you handle it, is that employment taxes have to be paid on the portion attributable to services provided, whether that's done on the W-2 or declaring the 1099 PATR as self-employment. That has to happen. So here are a bunch of examples. I want to mention that top one in particular, ABC. Okay, good. We've got another poll going on here. Oh, good. We just talked about this. You guys should get this one, I hope. Why are some worker co-ops structured as partnership entities? Because the IRC doesn't get more entertaining than subchapter K, because they love making their CPA enter hundreds of partners into the tax software, or because DOL rules designed to protect employees sometimes conflict with membership goals. So take a few seconds to answer that, and I'm going to go back to this examples slide. I want to mention that top one, ABC in particular, a bookkeeping cooperative, ABC, very cute. It's a bookkeeping co-op. I don't know if they're hiring or not, but if you're interested in these types of co-ops, if your interest has been piqued by this talk, maybe give them a call or start your own CPA firm co-op. See how that works. Oh, I hear somebody, they're hiring, but not hiring bookkeepers. Well, start your own. That's a way to do it. Oh gosh, nobody here believes that the IRC, the Internal Revenue Code, doesn't get more entertaining than subchapter K. I thought we all loved K the best. It's because they love making their CPA enter hundreds of partners into their tax software. You're correct. That is oh no, actually that's not right. It's because of the DOL rules, those labor rules that we just discussed. Good job, 86%, love it. All right, moving on. Wayne, any questions about worker co-ops that have come in?
Yes. And I want to thank Sarah Kaplan and Thomas Beckett and a few others for responding to some of the questions in the chat box.
Those are my people. Those are
exactly.
my Co-op Professionals Guild people. Oh my God. Hi, guys. It's so good to see you here. Thank you for coming and for helping.
I wanted to note that. So one of the questions is, how does a worker co-op differ from a union? And Sarah had entered a partial response, but maybe you'd want to address that a little bit.
I want to know what Sarah said. Can you read her response? Because that just, yeah, I mean, there are a lot of reasons, but Sarah, being a lawyer, has a much better insight into this than I do. But a worker co-op, you know, this is actually an entity, right? This is an economic entity. You are taxed in a particular way, and you're operating under these particular principles. Now, there may be overlapping goals for sure between a union and a worker co-op, but at the end of the day, with a worker co-op, the profit that worker co-op makes is coming back to the workers. And, you know, if you're a union at, say, a consumer co-op, a union at a grocery co-op, you're not getting that, you're not taking on that risk, but you're also not participating in the reward. I mean, that's the main answer.
Okay. In the interest of time, I'll move on to the next one here. And Sarah's response is it for the rest of you. And it's I'll let others read that. So
okay, great. Yeah. Take a look in chat. I'll read the chat afterwards, and
yeah,
it'll be interesting.
There is more interest lately in multi-stakeholder co-ops, i.e. worker members and consumer members, for example. Do you have any experience with accounting issues specific to these?
Yeah, they're a real pain in the tuchus. I'll just tell you that. I'm not personally a big fan of multi-stakeholder co-ops for a lot of reasons. The attorneys are more excited about them, I think, than the accountants in general, because they're really, really, really challenging. Because here's the big challenge, and I'm not saying they're not cool and creative and wonderful, and I'm glad we have them. I'm just really glad that I don't work with any, because you have to track patronage for more than one co-op at the same time within the same business, right? So it's really, really, really hard. It does solve some problems for sure that non-multi-stakeholder co-ops don't. For example, the daycare example that I gave, where the workers in the daycare and the parents, like they're really two different co-ops there, but they have overlapping goals. And so like it can really work great. But from an accounting perspective, like not my favorite thing, I have to say. Sorry,
Okay.
attorneys. I know that we're all really excited about them right now, but they're hard.
Should workers in a worker co-op be paid as employees, or is independent contractor status appropriate? You may have addressed that in part, but I'll pose it.
Yeah, there's one twist on that we didn't discuss. So not independent contractor status. That's important. So should they be classified as employees, or should all of it be paid out as 1099 PATR? Those are your options. I personally think it's much better if they can be classified as employees and have the 1099 PATR be the sort of wealth generating, return on investment, if you will, if we're talking about more traditional structures. That portion should be the 1099 PATR. But independent contractor status is not one of the options. They're not independent contractors. They are owners and they are employees, right? It's much more similar to an S Corp, although S Corps are not a good entity choice for co-ops in general. But in terms conceptually, from a tax and accounting perspective, it's much more similar to that. So they're not, it would be like paying the owner of a partnership or an S Corp like a 1099 independent contractor. Now, what you do see sometimes, though, is that you will see worker co-ops that also have independent contractors. Now, there was in an earlier slide, we referred to the definition, and that we're presuming that most of the workers are members as well, but not all of them, not 100%. It happens here and there. I have a beloved bicycle delivery co-op in Chicago that is one of my favorite co-op clients. They do such amazing things, and they have people who like pop into town for a couple of months from another city and they want to pick up a few shifts. That is not somebody who's participating in the democracy of what it means to have a workers co-op that are not getting a vote, all of that kind of thing. Those folks are paid as independent contractors. You really want to keep that to a minimum, but it does happen. So it was a good question. I'm glad somebody brought up the independent contractor situation.
Okay. Another question is, are there any state tax issues to be aware of for worker co-ops?
Oh, state tax issues. There really aren't. They're generally, I mean, I'm in Illinois 100% with all my co-ops. Is that right? I think so. I think all my co-ops are in Illinois, and we don't have any state issues whatsoever. There might be some people who are actually attending who are in states where there are complicating factors. But no, it's easy peasy in Illinois. We didn't used to have a good statute. Our statute was crap for a long time. It actually listed in the statute what kinds of businesses you could have in order to be considered a cooperative. And one of them was like being a farrier or something. It was like making horseshoes. It was really antiquated. And I worked with an amazing woman. I think she was at the Illinois Stewardship Council. She and I got to work with Will Gazzardi, our incredible state rep, and they actually got it changed. And now it's not a half bad statute. We don't have any tax issues. The Department of Revenue doesn't know or care what a co-op is. It just wants you to file a return.
Okay. Another question. Can you have a worker co-op with CPAs and bookkeepers owning equal shares?
I don't see why not. It's a great idea. Well, actually, let me be more clear about that. When you say owning equal shares, remember with a worker co-op, it's one worker, one vote. Everybody's got an equal share, right? That's kind of the whole point, is that we're all participating. Now, there's the weighted, if you're being taxed to subchapter K, you got to deal with weighted averages in terms of ownership throughout the course of the year as they're coming and going. That's another really fun one that I forgot to mention earlier, the weighted average percentage. But if you're actually talking about a co-op, it's one member, one vote. So everybody has an equal share, I think is the short answer there. They
Okay.
always will. Can you put both of them in the same co-op? I don't see why not. I think that's a great idea.
Okay, there's another question, and it comes from a highly regarded person. Is there a better term for co-ops that are not big three, credit union, utility, ag, commodity, besides hippie co-ops?
Yes. Is there a better term? Yes. Hippie co-ops is what we sort of, I'll tell you, the band Led Zeppelin, they got their name. They're one of my favorite bands. They got their name because of an early review that said, this music is so terrible, it's going to go down like a Led Zeppelin. And they're like, that's awesome. Let's rename ourselves Led Zeppelin. That's fantastic, right? So this was a sort of joking but insulting comment that somebody made at one point. And we took it and we ran with it, right? We were like, yeah, you know what? We kind of are hippie co-ops because we believe in co-ops as the best economic structure for making change for the better in our world. We believe that. And that's kind of a hippie ideal, right? In a good way, it's a hippie ideal. So we adopted that. Is there a better term? I mean, yeah, they're called worker co-ops, housing co-ops, daycare co-ops, consumer co-ops, groceries co-ops, et cetera. You know, they have their own names. I'm going to go back to that one of our earliest slides where I said there aren't two camps, right? There aren't two kinds of co-ops. The scope and breadth of co-ops is massive. It's not like there are these ones over here and those ones over here. No, there are a ton of them. And let's all work with all of them because we know co-ops. Who knows co-ops better than NSAC members, right?
Yeah, I'd like to enhance that just a little bit.
Please.
As the director of education for NSAC, I was a little hesitant about the using the term hippie co-ops because we didn't want to offend anyone, but it made it a fun topic, and that was a reference from years ago. And I would agree that it's probably not the best term going forward, but we hope nobody was offended by this, and we realize how important they are.
The first time that I presented on this topic to NSAC, they gave me the title for it. They said that they wanted it to be called non-traditional cooperatives. And I was like, okay, actually, if you look at the history of co-ops in the United States, they started with these types, not with those types, right? So these are the traditional co-ops, not the non-traditional co-ops. I didn't like that phrase. Yeah. So anyway.
So I think that's all the questions we have at the moment.
Okay, great. Well, let me blow through a few of these resources that I have here. I hope this overview of some co-op types that you might not be as familiar with was intriguing and educational. If you're interested in learning more, I want to highlight a webinar coming up in just a couple days with the Co-op Professionals Guild. It sounds like we've got some CPG folks here. I'm so glad you're here. Thank you so much. I learned, most of what I learned about co-ops was either from NSAC or from CPG. Like those were really my two resources. So anyway, that group of hippies, as we were talking about, in a couple of days, they're doing one that actually features a couple wonderful colleagues from NSAC as well, Becky and Cherie, and it's sure to be a good one. So the information's up on the screen. I would highly encourage you to not only attend this, but to join Co-op Professionals Guild. It's not expensive. They do all sorts of webinars, and they have a conference, an annual conference. They're just a wonderful group. I know that this was an all too brief overview, so I've included a few slides to highlight some of my favorite resources, not just for us as accountants, but to recommend to clients looking to start co-ops. The Co-op Professionals Guild puts on regular webinars, as I just mentioned, and an annual conference, and comprises a stellar group of attorneys, accountants, and other professionals who work with co-ops. The SELC offers an incredible legal resource library that is so helpful. The link is there on the slide. the University of Wisconsin Center for Co-ops, which I've mentioned like 1,000 times, because at this point, they're almost a one-stop shop for everything you need to know about co-ops. And I can't thank them enough for their commitment. Also down there at the bottom of the slide, you'll see a link to a video by Bruce Mayer. He's sort of the guru of our co-op tax world. That is on taxes and accounting for startup food co-ops. That's a super handy resource as well. And then national trade associations. Here are a bunch of trade associations that specialize in the, oh, looks like we've got a final poll and ending evaluation here. I'll give you 60 seconds to do this one as well while I continue to talk through these resources. These trade associations specialize in the various types of co-ops we discussed today. I really lean on NCG, National Cooperative Grocers, a lot. They've been truly gracious with their help. They're a cooperative of co-ops, so they're a federated co-op, and they're great. All these folks are really great. And then we've got the worker co-op associations and projects. Oh my gosh, so much cool stuff going on out there. Specifically, Democracy at Work Institute and Project Equity. I want to highlight those because these are organizations that are doing some of what I was talking before, where they're actually using worker co-ops in a way that it helps small businesses stay in their communities. It helps with succession planning, transitioning to employee ownership. It helps with, bringing co-ops to economically and bringing jobs to economically and socially marginalized communities. There are some pretty excellent projects going on. And then, of course, local resources. Check out your local network of co-op alliances. We have a ton in Chicago, and I know they exist across the country. So ask around. In Chicago, we've got a couple really good Facebook groups that highlight a lot of this stuff. And it's a really good way to connect with people, to connect with the folks, not just the advisors working with the co-ops, but with the folks who are running the co-ops. And hey, they might need an accountant. It's a really good way to meet people. So that's the end of what I have. I know we're getting close to time, but if there are any last questions, I'm happy to take them.
Well, I think we need to wrap up, be respectful of your time and the time of all of our participants. But I want to thank you.